So, a key theme running through this material seems to be that Marvell's pivot is complete, citing that massive 98% year-over-year jump in data center revenue, creating a second chance entry point before the December 2nd earnings.
Yeah, and that 98% figure, that whole idea of the data center boom you missed, is a tremendously strong hook. The analysis is clearly deep, so let's just jump straight in, yeah? Let's talk about how we can strengthen the core tensions the market's really grappling with right now.
Okay, let's do it. We should probably start with the biggest challenge for Marvell, which is the balance sheet. I mean, the discussion around gross margin stabilization, it needs stronger context, specifically on the risks with that custom compute transition.
Right, the ASIC business. That's the application-specific integrated circuits. And there's an inherent margin drag there, compared to their standard parts.
Of course.
The analysis gets that. It correctly says custom silicon has lower margins, and that investors need to see margins stabilizing around that 60% target. But I think where it could be stronger is in shifting that margin stability from just a passive number something to watch into the active central tension of the story.
That makes a lot of sense. So the weakness is that the piece treats this like a metric to keep an eye on, not the absolute core of the investment thesis.
Exactly. Look, if that high-growth custom compute segment, the big wins with AWS, Google, Microsoft, if that ramps as aggressively as everyone thinks it will, the margin compression could actually outweigh the volume growth in the short term.
Which means they could post amazing revenue numbers and still get punished by the market.
Precisely. So the suggestion here is to reframe that whole discussion. You need to actively model how Marvell's plans to mitigate that dilution from the lower margin ASIC volume. And that means you have to integrate the two drivers, the ASICs and the optics, much more explicitly.
I think the rater would really appreciate that level of depth. I mean, if the blended gross margin sinks from, say, 60% down to 55% just because of that mix shift, the market is definitely going to react badly.
It will.
So what would that active modeling actually look like in the piece?
You need to show the mathematical tightrope they're walking. I'd introduce a section that actually forecasts the expected revenue mix shift. You have to explain, precisely how growth in the high-margin optical interconnects, the DSPs for 800 gig and 1.6 terabit speeds, how that's required to offset the custom compute dilution just to hold that 60% line.
Okay, that's very specific and actionable. So you could literally say if custom compute hits X billion in 2026 at a 45% margin, Marvell needs optics to hit Y billion at a 70% margin just to maintain a blended 60%.
Yes, exactly, because that shows the structural necessity. It shows both parts have to work together perfectly.
And that elevates the optics business beyond just being, infrastructure revenue. It becomes the profit lever.
It's the profit lever, absolutely. And building on that, let's challenge the assumption that custom compute is purely a low-margin hardware sale.
How do you mean?
Well, the piece could suggest exploring if Marvell has secured IP licensing fees or attached software revenue streams that would implicitly raise the blended margin over the multi-year cycle of the contract.
Ah, I see.
Think about it. If the analysis shows that the initial hardware delivery is low margin, but then you've got software updates or IP access fees coming in at 90% margin, well, that completely changes the long-term profitability picture, doesn't it?
It does. That's a key piece of diligence people often miss. It shifts the whole thing from a simple cost of goods problem to a structural business model analysis. That's much more compelling.
It is. Now, if we shift from the balance sheet focus over to the strategic narrative, that brings us to the second major critique point.
Okay, which is that the narrative structure relies too heavily on proving that the past 98% growth was legitimate instead of establishing the unique advantages that justify the future breakout.
That's a great way to put it. The material opened strong, noting the 98% figure was missed because investors were all looking at NVIDIA and AMD, not connectors like Marvell. And that's true. But spending too much time correcting that historical mistake makes the whole piece feel
retrospective.
So the weakness is that it's looking backward too much.
Right. The focus needs to pivot, and pivot fast, from what was missed to what makes Marvell's competitive advantage truly unassailable going forward.
And the piece needs to really define that forward-looking mode. It mentions the strength in optical interconnects, it calls it the plumbing, but it doesn't really leverage it as the key differentiator.
Correct.
So the suggestion is to elevate Marvell's dominance in high-speed optical DSPs, those really complex digital signal processors for 800G and 1.6T, and make that the primary forward-looking competitive mode.
I like that.
That positioning actually de-risks the custom compute business, and it gives you a unique angle to justify higher multiples compared to, pure play silicon design houses.
Yeah, that completely changes the story. It goes from MRVL has two good businesses to MRVL controls the two most critical components for hyperscale AI. That makes the thesis truly structural. But why exactly are those optical DSPs a moat? Tell me more about the technical barriers there. What makes 1.6T so hard for competitors to copy?
And that is the exploration that needs to be embedded in the script. You've got to elaborate on why MRVL dominates this market. You could discuss the technical barriers of integrating these bleeding-edge speeds into massive data center clusters. It's not just about having the chip.
It's the system-level challenge.
It's the decades of IP. It's the certification process. That creates extremely high switching costs for customers, like an AWS or a Google. Once the reader understands why it's so hard to displace MRVL's DSPs once they're designed in, they'll understand the true stickiness of that revenue.
And we have to connect that moat directly back to the custom compute wins. They can't be presented as two separate product lines.
Absolutely not. You have to present MRVL as offering a necessary integrated package. They aren't just selling you the custom chip or the optical solution. They're the one partner who designs the custom silicon and provides the critical plumbing to make the whole cluster work.
I hear you, but wouldn't integrating them like that make MRVL a single point of failure for the customer? How would you address that risk without undermining the argument?
That's a great challenge to raise in the text. You should face it head on. The counterargument is that integration actually reduces complexity and risk for the hyperscalers. By controlling both the custom silicon and the high-speed interface, MRVL guarantees compatibility and performance.
Something you can't get by mixing and matching vendors.
You can't. You can't get that sourcing the ASIC from company A and the DSP from company B. So this transforms the narrative from selling two products into selling a unified, structural ecosystem solution. And that's a much stronger case for a long-term breakout.
That level of depth is perfect for this audience. Okay, let's move to the last section then, the conclusion and the call to action. The material does a great job framing this as a second chance entry point, arguing for a structural multi-year cycle.
It does. The verdict is very high conviction. But then the final conclusion creates this thematic dissonance. It pairs this really strong multi-year fundamental analysis with a specific near-term technical trading signal.
Right. So the weakness is that the report correctly says the 98% boom is the start of a multi-year cycle. That the price being down while fundamentals are up offers a rare entry. But then the call to action is watch the $80 level closely this week.
Which just shifts the focus abruptly from structural investing to tactical trading.
And that kind of damages the credibility of the whole macro thesis, doesn't it?
It really does. I mean, if you're arguing the next 3 years of AI growth are locked in, why on earth should the reader care about a technical price level this week? It suggests you don't fully believe your own structural argument.
It signals a lack of conviction.
Exactly. If the fundamentals are solid and the stock's at a discount, the focus has to be on the confirmation events that validate that cycle, not short-term price charts.
So the suggestion is to recalibrate the conclusion, reinforce the structural investment thesis, and make the action point fundamentally driven, not technically driven.
Precisely. Replace the $80 level watch point with a definitive focus on the big upcoming catalyst, which is the December 2nd earnings report. The final instruction needs to be to watch for a specific fundamental confirmation.
A concrete example of that would be focusing on a specific raise in the overall AI revenue target guidance, or maybe confirmation of the mass production ramp for a big customer like Microsoft.
Yes, either of those would work. Those are the high conviction moments that validate the structural thesis that the whole report has been building. And we also need to refine the language to match that commitment.
So maybe refining a phrase like "don't chase the green candles you missed" to something stronger about positioning for the confirmation of the structural shift?
Absolutely. Focus the language on the implied valuation gap, compared to peers like NVIDIA or Broadcom, if that 60% margin target is maintained. Something like, the upcoming December 2nd report is your final confirmation point. We are positioning not for a technical bounce, but for the structural repricing that's required once the market acknowledges the sustained 60% margin and the integrated AI mode.
That uses the peer comparison already in the material to justify the second chance idea from a purely fundamental standpoint.
Exactly.
This has been a really targeted and, I think, deep dive into what is already a powerful thesis about this data center boom you missed. The material is strong, but these adjustments could really maximize its impact.
I completely agree.
Okay. To quickly recap the most actionable suggestions for the listener. First, explicitly model the required revenue mix. You need to show the mathematical dependency between high-margin optics and lower-margin custom compute to sustain that critical 60% margin target.
Second, reframe that optical interconnect story. Make it the primary competitive moat that validates the ASIC growth and really cement MRVL as controlling the complete integrated AI infrastructure package.
And finally, make sure the conclusion is structurally aligned. Focus the call to action on fundamental catalysts like specific guidance raises in the December 2nd earnings report, instead of relying on short-term technical price levels.
This is exceptionally strong material to start with. These revisions, they just provide the necessary depth to handle that complexity of margin compression while really leveraging the unique structural advantage MRVL has. You've done all the heavy lifting, now it's just about optimizing the delivery of the narrative.
We genuinely look forward to seeing the revised version. Please send it back in when you've had a chance to make those adjustments.